You've heard the promise, right? Stablecoins are supposed to be the bedrock of the crypto world, a safe haven from all that volatility. But what happens when that bedrock starts to show cracks? That's what we're digging into. We'll break down what stablecoins are, why they've got global regulators on high alert, and how the battle to control them is shaping the future of money. So what's the big idea behind stablecoins anyway? Well, think of them as a bridge. On one side, you've got the wild, chaotic world of crypto. On the other, the stability of traditional finance. Stablecoins are meant to connect the two. And the core promise? It's really simple. One digital coin is supposed to be worth one real-world dollar, period. And let's be clear, this isn't some tiny niche corner of finance anymore. Not even close. The market has just exploded. We're talking about going from just $3 billion in 2019 to a projected $300 billion by 2025. When something grows 100-fold in just a handful of years, it stops being a curiosity and starts being something that forces the world's biggest players to sit up and pay very close attention.
Okay, so that's the promise, but how do they actually do it? What's the magic trick that's supposed to keep one digital dollar worth one real dollar?
It all comes down to one key concept: collateralization. The idea is for every single digital coin out there, the company that issued it is supposed to have $1 worth of real, safe assets tucked away. We're talking about things like government bonds, cold hard cash. And this isn't just some boring accounting detail. This is everything. It's the foundation of trust for the entire system. And you can bet that the transparency, or lack thereof, of those reserves is a huge point of debate. All right, so here's where it gets really interesting. That explosive growth we talked about, and that whole collateral mechanism, well, they're creating these new, deep connections back to the traditional financial system. And with new connections come new risks. It's why global watchdogs, the big ones like the IMF and the European Central Bank, are now on high alert.
And they're not just worried, they're analyzing it. The IMF, for example, put out a report on this. They've pinpointed 3 main ways that stablecoins could potentially set off a major crisis.
Okay, let's look at these 3 risks. The first one, currency substitution, is a big deal, but mostly for economies with weaker currencies. It's the next 2 that have everyone, everywhere worried. Think about it. When you've got companies managing hundreds of billions in reserves, their buying and selling can actually move huge markets, like the bond market. But really, it's that third one, the risk of a run. That's the real nightmare scenario for regulators. And this danger gets a whole lot bigger because the market is so incredibly concentrated. You've basically got 2 giants, Tether and Circle, running the whole show. It's like if the entire world's shipping relied on just 2 ports. That's a massive single point of failure. If something goes wrong with either one of them, the whole system could be in jeopardy.
This right here, this is the nightmare scenario we're talking about. It's a bank run, but for the digital age. Imagine a sudden panic, a total loss of confidence. Everyone rushes to cash out at once. To meet those demands, the company has no choice but to sell off its reserves. We're talking hundreds of billions in government bonds, all at once. It's a fire sale. That crashes bond prices and triggers a contagion, a domino effect that could spread like a virus through the entire global financial system, even parts that have nothing to do with crypto.
So, faced with risks like that, it's pretty clear the Wild West days of crypto are over. Done. Regulators all over the world have decided they can't just watch from the sidelines anymore. They're jumping in and starting to build some serious rules.
And we're not talking about a few small tweaks here. This is a massive paradigm shift. The whole goal is to drag crypto out of that speculative, anonymous, unregulated frontier and turn it into a market that's legally solid, totally transparent, and plugged right into the global economy.
So how are they doing it? Well, you're seeing big, comprehensive laws pop up. Europe's leading the charge with its MiCA regulation. The US is pushing its own stablecoin laws. And then you've got the global players, like the Financial Stability Board setting rules for the G20, and the OECD building a tax framework to make sure everything's above board. That MiCA law in Europe, by the way, is a really big deal. It's pretty much the first serious attempt to create one single, unified set of rules for the whole crypto market. It lays down strict guidelines for issuers on pretty much everything, how they manage their reserves, how transparent they have to be. It's basically saying, okay, from now on, we're treating stablecoins like real regulated money. But, regulation is never a silver bullet. The European Systemic Risk Board is already pointing out a potential huge loophole, these really complex cross-border stablecoins. Just think about it. A company based in one country, holding its reserves in another, with all its users in a third.
These messy setups could let companies slip right through the cracks of the rules. It just goes to show this whole cat-and-mouse game between regulators and innovators is far from over.
So, with all that said, what's next? Where do stablecoins actually fit in the grand scheme of things? Well, their future is really going to be shaped by this constant push and pull between four big forces. You've got the ever-changing regulations, you've got private sector innovation, like what can companies actually build with this stuff, then there's the reaction from the old guard, like Visa and SWIFT, and of course, the elephant in the room, central bank digital currencies. Are stablecoins going to compete with something like a digital euro, or will they just be made obsolete by it?
And this leads to a really crucial insight. It's easy to think of all this regulation as a bad thing, something that stifles innovation. But actually, it might be the exact opposite. It could be the very thing that finally makes crypto mainstream. It provides that legal certainty, that trust, that big investors and regular people need before they're willing to really start using this stuff every day. So, what's the bottom line? The era of wild speculation is giving way to an era of real integration. The days of operating in the shadows are over. Stablecoins are growing up. Their future looks like it's going to be transparent, regulated, and, without a doubt, a core piece of the global financial puzzle for years to come.